Comprehensive Financial Analysis and Options Swing Trading Strategy for SPDR Portfolio S&P 500 ETF, SPYM. Executive Summary. The SPDR Portfolio S&P 500 ETF, SPYM, has rapidly emerged as the premier low-cost alternative to the SPDR S&P 500 ETF Trust, SPY, for investors seeking S&P 500 exposure under $100 per share. Backed by State Street, SPYM offers a rock-bottom 0.02% expense ratio, robust tracking of the S&P 500, and a structure optimized for long-term, cost-conscious investors. This report provides a thorough financial analysis of SPYM, including its structure, performance, expense ratio, liquidity, and a detailed comparison to SPY. It then develops a research-backed swing trading option strategy tailored for small accounts, with actionable recommendations for contract selection, risk management, and broker execution. 1. SPYM, Fund Structure, Issuer, and Core Characteristics. 1.1 Fund Overview and Issuer Details. SPYM is an exchange-traded fund, ETF, managed by State Street Global Advisors, one of the world's largest and most reputable asset managers. Launched in November 2005, SPYM seeks to replicate the total return performance of the S&P 500 index, which represents approximately 80% of the U.S. equity market by capitalization. The fund is structured as an open-end ETF, providing flexibility for dividend reinvestment and securities lending, features that distinguish it from the Unit Investment Trust, UIT, structure of SPY. SPYM's open-end structure allows for efficient cash management, automatic dividend reinvestment, and the ability to lend securities for incremental income. These operational efficiencies contribute to its ultra-low expense ratio and minimal tracking error. Key fund facts. Issuer, State Street Global Advisors. Inception date, November 8, 2005. Structure, open-end ETF. Benchmark, S&P 500 Index. Expense ratio, 0.02%. Assets under management, AUM $106 billion, as of February 2026. Share price, $81, as of February 2026. Dividend yield, 1.12%, paid quarterly. Number of holdings, 504 to 506. Replication method, full replication, holds all S&P 500 constituents. 1.2 Holdings in sector allocation. SPYM holds every stock in the S&P 500, weighted by market capitalization. Its top 10 holdings mirror the index and include the largest U.S. companies, such as Nvidia, Apple, Microsoft, Amazon, Alphabet, Broadcom, Meta Platforms, Tesla, and Berkshire Hathaway. The top 10 represent approximately 37 to 39% of total assets, reflecting the current concentration in megacap technology and growth stocks. Sector allocation, as of February 2026. Information technology, 35%. Financials, 13%. Communication services, 11%. Consumer discretionary, 10%. Healthcare, 9.6%. Industrials, 8.9%. Consumer staples, 5.3%. Energy, 3.3%. Utilities, 2.3%. Materials, 2%. Real estate, 1.9%. This sector breakdown is virtually identical to SPY, ensuring that SPYM delivers the same economic exposure and risk profile as its higher-priced counterpart. 2. Expense ratio and fee comparison, SPYM versus SPY versus VO. 2.1 Expense ratios, the compounding advantage. SPYM's defining feature is its ultra-low expense ratio of 0.02%, which is the lowest among major S&P 500 ETFs. In comparison, SPY, 0.0945%, UIT structure. VO, Vanguard S&P 500 ETF 0.03%, open-end ETF. Table, S&P 500 ETF expense ratios and accessibility. Sources, State Street, Vanguard, ETF Savant, A-Invest, ETFDB, Stock Analysis, Yahoo Finance. Analysis. While the difference between 0.02% and 0.09% may seem trivial, the compounding effect over decades is substantial. For example, on a $10,000 investment, the annual fee gap between SPY and SPYM is $7. Over 30 years, assuming a 7% annual return and monthly contributions, this can result in a portfolio value difference of $16,000 to $90,000 in favor of SPYM. 2.2 Fee impact on long-term returns. The lower expense ratio directly translates into higher net returns for investors, especially for buy and hold and dollar cost averaging strategies. This is particularly advantageous for small accounts, where every basis point saved is meaningful. 3. Performance and tracking error. 3.1 Historical performance. SPYM's performance is virtually indistinguishable from SPY and VOO, as all three track the same S&P 500 index using full replication. Over the past decade, the annualized returns for SPYM and SPY have been within a few basis points of each other. Table: SPYM versus SPY performance, as of Jan/February 2026. Sources: State Street, Vanguard, Morningstar, Finance Charts, Yahoo Finance. Analysis. The minuscule differences in returns are attributable to the slightly lower expense ratio and more efficient dividend reinvestment in SPYM's open-end structure. Over long periods, SPYM may even slightly outperform SPY due to these structural advantages. 3.2 Tracking error. SPYM's tracking error versus the S&P 500 index is extremely low, typically less than 0.05% annually. This is achieved through full replication and efficient portfolio management. The open-end structure allows for continuous rebalancing and reinvestment of dividends, further minimizing tracking error compared to SPY's UIT structure, which cannot reinvest dividends. 4. Liquidity and trading volume analysis. 4.1 Trading volume and bid-ask spreads. SPY is the world's most liquid ETF, with average daily trading volume exceeding $52 to $74 billion and bid-ask spreads as tight as 0.005%, about 1 cent per share. SPYM, while less liquid, still boasts robust trading volume averaging 9 to 10 million shares daily and a bid-ask spread of about 1 cent, 0.016% in percentage terms. Table: Liquidity metrics. Analysis. For most retail investors and swing traders, SPYM's liquidity is more than sufficient. However, for institutional traders or those executing very large orders, SPY's deeper liquidity may offer marginally better execution, especially during periods of market stress. 4.2 Slippage and execution. Bid-ask spreads and slippage are critical for options traders. SPYM's spreads are slightly wider in percentage terms than SPY, but still tight enough for efficient execution. Using limit orders and trading during regular market hours can further minimize slippage. 5. Replication methodology and holdings. SPYM uses full replication, holding all 500 plus stocks in the S&P 500 index in their exact market cap weights. This approach ensures minimal tracking error and maximum transparency. The fund's top holdings and sector allocations are nearly identical to SPY and VOO. Top 10 holdings, February 2026. 1. Nvidia Corp., 7.19%. 2. Apple Inc., 7.02%. 3. Microsoft Corp., 5.04%. 4. Amazon.com Inc., 3.73%. 5. Alphabet Inc. Class A, 3.32%. 6. Alphabet Inc. Class C, 2.65%. 7. Broadcom Inc., 2.52%. 8. Meta Platforms Inc., 2.51%. 9. Tesla Inc., 1.92%. 10. Berkshire Hathaway Inc., 1.59%. 6. Dividend policy and tax treatment. 6.1 Dividend yield and distribution. SPYM pays dividends quarterly, with a current yield of approximately 1.12%, slightly higher than SPY and VOO due to efficient reinvestment and lower fees. The fund's open-end structure allows for immediate reinvestment of dividends, maximizing compounding. Recent dividend payments, 2025. DEC, $0.23818 per share. SEP, $0.23823 per share. June, $0.21361 per share. MAR, $0.21741 per share. 6.2 Tax treatment. SPYM's dividends are generally classified as qualified dividends, eligible for favorable long-term capital gains tax rates for U.S. investors, provided holding period requirements are met. The ETF structure also enables in-kind redemptions, minimizing capital gains distributions and enhancing tax efficiency. 7. Why SPYM is the closest low-cost alternative to SPY under $100. 7.1 Accessibility and dollar cost averaging. SPYM's share price, $690, and VO, $600, enabling more flexible position sizing and easier dollar cost averaging. 7.2 Cost efficiency and long-term compounding. The 0.02% expense ratio is the lowest among major S&P 500 ETFs, maximizing long-term compounding for buy-and-hold investors. Over decades, this cost advantage can translate into thousands of dollars in additional returns, especially for small accounts. 7.3 Institutional backing and credibility. SPYM is managed by State Street, the same issuer as SPY, ensuring institutional-grade oversight, transparency, and operational robustness. This makes SPYM a credible, reliable core holding for both retail and institutional investors. 8. Risks and drawbacks of using SPYM instead of SPY. 8.1 Liquidity premium. SPY's unmatched liquidity and options market depth make it the preferred vehicle for high-frequency traders, large institutions, and those executing complex options strategies. While SPYM's liquidity is ample for most retail traders, it may not match SPY's efficiency for very large or rapid trades. 8.2 Behavioral inertia. Many investors default to SPY or VO out of familiarity, despite higher fees. This behavioral inertia can slow the adoption of SPYM, potentially limiting its liquidity growth relative to SPY. 8.3 Tracking error in extreme markets. During periods of extreme market stress, less liquid ETFs can experience wider bid-ask spreads and temporary tracking error. However, SPYM's structure and scale mitigate most of these risks for typical account sizes. 9. Options market for SPYM, availability and liquidity. 9.1 Options availability. SPYM offers listed options with multiple expiration dates, weeklies, monthlies, and leaps, similar to SPY. The options market for SPYM is active, with open interest and trading volume concentrated around at the money and near the money strikes, especially for expirations 30 to 60 days out. Sample option chain, March 20, 2026 expiration. $81 call, open interest 465, volume 3. $80 call, open interest 115, volume 3. $80 put, open interest 51, volume 10. $78 put, open interest 71, volume 2. 9.2 Liquidity and bid-ask spreads. While SPYM options are less liquid than SPYs, they are sufficiently active for small to medium-sized trades. Bid-ask spreads are generally 5 to 10 cents for at-the-money strikes, widening for deep and out-of-the-money contracts. For most swing trading strategies, this liquidity is adequate, especially when using limit orders. 10. Technical analysis indicators for swing trading SPYM. 10.1 Core technical indicators. Successful swing trading in SPYM options relies on a blend of trend, momentum, and volatility indicators. The most effective and widely validated indicators for swing trading SPYM include moving averages, MA 20-day and 50-day EMAs for trend direction and support/resistance. Relative Strength Index, RSI 14 period for overbought/oversold signals and divergence. MACD, Moving Average Convergence Divergence 12, 26, 9 settings for momentum shifts and crossovers. Bollinger Bands, 20 period for volatility breakouts and mean reversion. Volume, confirmation of breakouts and trend strength. Support and resistance levels, key price zones for entries and exits. Table, top technical indicators for SPYM swing trading. Analysis. Combining 2 to 3 complementary indicators, e.g., trend plus momentum plus volume, increases signal reliability and reduces false positives. For SPYM, daily charts are optimal for swing trades lasting 2 to 10 days. 11. Option strategies for small accounts, swing trading SPYM. 11.1 Strategy selection criteria. Small accounts, less than $10,000, require strategies that are defined risk, maximum loss is known upfront. Capital efficient, low margin requirements. Theta resilient, manageable time decay. Liquid, easy to enter/exit with minimal slippage. Scalable, adaptable as account grows. 11.2 Recommended strategies. At debit spreads, vertical spreads. Bull call spread, buy ATM/near ATM call, sell OTM call, same expiration. Bear put spread, buy ATM/near ATM put, sell OTM put, same expiration. Advantages. Defined risk and reward. Lower cost than naked long options. Capital efficiency, ideal for accounts less than $5,000. Less sensitive to rapid theta decay than naked options. B. Credit spreads, vertical spreads. Bull put spread, sell OTM put, buy further OTM put, same expiration. Bear call spread, sell OTM call, buy further OTM call, same expiration. Advantages. Defined risk and reward. Collect premium upfront. High probability of profit if strikes are chosen wisely. Can be managed/closed early for partial profit. C. Long calls/puts, directional. Buy ATM or slightly ITM call/put for directional swing trades. Higher risk of theta decay, best for short holding periods and strong conviction. D. Diagonal spreads. Buy longer dated IDM/ATM option, sell shorter dated OTM option. Benefit from time decay on short leg and directional move on long leg. E. The wheel strategy, for larger accounts. Sell cash secured puts, if assigned, sell covered calls. Requires capital to buy 100 shares, best for accounts greater than $8,000. 12. Greeks and contract selection guidance for SPYM options. 12.1 Understanding the Greeks. Delta measures sensitivity to underlying price changes. For calls, delta ranges from 0 to +1, for puts, from 0 to -1. A 0.50 delta option moves 50 cents for every $1 move in SPYM. Gamma measures the rate of change of delta. Highest for ATM options. Theta measures time decay. Highest, most negative, for ATM options close to expiration. Vega measures sensitivity to implied volatility. Higher for longer dated ATM options. Contract selection guidelines. Delta, for directional trades, select options with delta 0.40 to 0.60, ATM or slightly ITM, for a balance of price sensitivity and time decay. Theta, avoid contracts with less than 7 days to expiration unless selling premium. For debit spreads, 21 to 45 DTE is optimal. Liquidity, choose strikes with high open interest and volume, typically ATM and 1/2 strikes OTM. Bid-ask spread, prefer contracts with spreads less than 10 cents for efficient execution. 13. Position sizing and risk management for small accounts. 13.1 Position sizing rules. Risk per trade, limit to 1 to 2% of total account value. Maximum open positions, 3 to 5 for accounts less than $5,000. Fixed fractional method, allocate a fixed percentage of capital per trade, adjust as account grows. Kelly criterion, fractional for advanced users, use 1/2 or 1/4 Kelly to balance growth and drawdown risk. Example. For a $2,000 account, risk $20 to $40 per trade. If a debit spread costs $100, this is 5% of the account, too high. Instead, use $50 spreads or trade fewer contracts. 13.2 Stop loss and exit criteria. Stop loss, set at 50% of premium paid, for debit spreads, or 2x premium received, for credit spreads. Profit target, 50 to 75% of maximum profit. Time-based exit, close positions with less than 7 days to expiration to avoid rapid theta decay. Diversification, avoid overconcentration in one direction or sector. 14. Recommended SPYM options contracts by account size. Table, SPYM options contract recommendations by account size, March 2026, SPYM $81. Asterisk notes. All examples use March 20, 2026 expiration. Adjust strikes to maintain risk per trade at 1 to 2% of account. Select contracts with open interest greater than 100 for liquidity. Use limit orders to minimize slippage *. Analysis. For accounts less than $1,000, stick to single contract debit or credit spreads with narrow widths, $2 to $3. For $1,000 to $5,000, scale up to 2 to 3 contracts or slightly wider spreads. For $5,000 to $10,000, diversify across multiple strikes and expirations, but never risk more than 2% per trade. 15. Backtesting and historical performance of proposed strategies. 15.1 Absolute Momentum Long-Only Strategy, SPYM. A backtest of a simple momentum strategy, long SPYM, when 252-day rate of change 0 and price greater than 200-day SMA, exit on close less than 200-day SMA or after 20 days, or at plus 8% TP/a 4% SL, produced the following results, 2024 to 2026. Sources, A Invest News, ETF Savant. Analysis. While the annualized return is modest, the strategy demonstrates positive expectancy and manageable drawdowns. Option strategies, debit/credit spreads, layered on top of these signals can further enhance returns, especially when using technical confirmation, e.g., RSI, MACD crossovers. 15.2 Options Backtests. Backtests of 30 to 45 DTE put credit spreads on SPY, proxy for SPYM, show win rates of 85 to 93% for 0.30 delta short puts. Sharp ratios improve when using 50% profit targets and closing at 15 to 21 DTE. Lower position sizes, 5% of capital, reduce drawdowns and volatility. 16. Execution considerations and broker selection. 16.1 Execution best practices. Use limit orders, avoid market orders to minimize slippage, especially in less liquid contracts. Trade during regular hours, liquidity is highest and spreads are tightest. Monitor open interest, choose strikes with greater than 100 open interest for easier entry/exit. Avoid trading near major news events, volatility can widen spreads and increase slippage. 16.2 Broker selection for small accounts. Top brokers for options trading, 2026. Sources, NerdWallet, BrokerChooser, Brokerage Review. Analysis. For small accounts, zero-commission brokers like Webull, Robinhood, and FirstTrade maximize capital efficiency. For advanced analytics and execution, Fidelity, Schwab, and Interactive brokers are top choices. Always verify that your broker supports multi-leg option strategies and provides real-time Greeks and analytics. 17. Summary Table, SPYM versus SPY. Sources, ETF Savant, InvestLane, State Street, ETFDB, Stock Analysis, Yahoo Finance. 18. Conclusion, the case for SPYM and a disciplined option swing trading approach. SPYM stands as the closest, most cost-effective alternative to SPY for investors and traders seeking S&P 500 exposure under $100 per share. Its 0.02% expense ratio, robust tracking, and open-end structure deliver maximum compounding and operational efficiency. While SPY remains the liquidity king for institutional and high-frequency traders, SPYM's liquidity is more than sufficient for most retail investors and swing traders. For small accounts, defined risk option strategies such as debit and credit spreads offer the best blend of capital efficiency, risk control, and profit potential. By combining robust technical analysis, moving averages, RSI, MACD volume, with disciplined position sizing, 1 to 2% risk per trade, traders can swing trade SPYM options with confidence. Broker selection should prioritize low fees, platform reliability, and support for multi-leg strategies. Key takeaways. SPYM is the optimal low-cost S&P 500 ETF for accounts under $100 per share, maximizing long-term returns through fee minimization. Option swing trading on SPYM is viable for small accounts using debit/credit spreads, with careful attention to liquidity, Greeks, and risk management. Position sizing, disciplined exits, and broker selection are critical for sustainable success. By adhering to these principles and leveraging the structural advantages of SPYM, investors and traders can build resilient, cost-efficient portfolios and trading strategies that stand the test of time.